Welcome back to the National Real Estate Cafe with Don Gatling and Gino Fronti. We're almost 3 years now. We've been sharing with you daily what's really, no fake news, what's really happened in the real estate and financial markets. And it's really imperative with all the volatility we're seeing recently, especially with interest rates going up. We just showed that they've been increasing since January. Here's one of the reasons why, right, Gino?
Yeah, this is the silent reason why. So let's take a look at this. So one of the reasons we know, as we talked a little bit about the other day, is that the economy is doing well. Employment's at full employment. There's concern about inflation. All those are good reasons why rates are going up, but here's another one. So this is kind of like the perfect storm. There's a lot of reasons why rates are rising.
And this is behind the scenes. This is the stuff you don't see. And when it's amazing, only so many are talking about it because it's a little over most of our heads. But bottom line is the Fed's got involved to help keep interest rates low to help stimulate the economy. One of the ways they were doing it was buying our mortgage-backed securities, or basically our bonds, to keep interest rates down, keeping the supply down. If there's not enough supply, then their interest rates stay down. They don't have to raise the interest rates to attract more investors.
Right. So what we're doing here is we're allowing the market. Every time you refinance, a new mortgage-backed security kind of goes back on the market. What used to happen is the Fed would buy that mortgage-backed security and put it back on the balance sheet, and that would allow for rates to kind of stay status quo.
Right.
Now they're leaving that mortgage-backed security out in the open market for somebody else to buy. So we are now bringing in private investors to purchase things that were being subsidized by the government. This is a good thing. We're removing government subsidies. We're fixing the Fed balance sheet. We're making sure we don't cause a bubble.
There you go. So what they're doing is basically on a pretty regular basis since October of last year, throughout this year, they're going to be backing off a substantial amount, too. We're talking $4 billion each decrease in the amount of mortgage-backed securities. So that means there's a huge supply out there, and to attract those private investors, we're going to have to raise interest rates to attract them to buy our debt, basically.
Interestingly enough, one of the things that was pulling people out of bonds and into the stock market was this raging stock market. So with the correction that we saw in the stock market, that puts a little bit of fear back in those institutional investors saying, maybe it's not all that safe in the stock market. Let's buy some bonds. So the Fed is trying to strike a balance. There's going to be moments of volatility, but I think they're doing a great job.
And what this means to you, because nobody likes rising interest rates, nobody likes the stock market corrections. Bottom line is, this is all signs that the economy is stabilizing. It's normalizing. So we don't need stimulus. We don't have peaks and valleys. It's stabilizing and having a more normal market, so which is really good for all of us.
I know this is kind of like bigger picture stuff, but that means that we're going to reduce government spending technically. So if we reduce government spending, then we can reduce taxation and all that good stuff if it all goes the way it's planned.
All right, you heard right here on the National Real Estate Cafe. You can get these sent right to your phone by texting NREC to the number 58885 or find out more at donandgino.com.